Okay, I think we're ready to go. So good morning, everyone. Very warm welcome to you and thanks for joining us today. I'm very conscious that you could be out sunbathing today, so thanks for choosing to watch us instead. I'm John Moffat. I'm a director at Benson Wood. We're chartered accountants and business advisors, and we're based in Airdrie, North Lanarkshire. We work with many owner-managed businesses, providing business advisory, accountancy, tax, VAT, bookkeeping, and payroll services. Just some admin stuff. There's a Q&A box on your Zoom app, whether it's on your phone or your PC. So any questions you have as we're going through, if you add them into the Q&A box, and we'll answer them at the end of the webinar. So again, I would say welcome to the webinar. We've called this Business Challenges Heading Out of Lockdown, and it's the first in a series of Business Challenges webinars that we'll be running. So in this, we'll cover cash management, cash flow, pricing, and business finance. So as we're coming out of lockdown, what we're looking for is certainty and clarity. So put simply, if you can understand your cash flow and how to manage your cash, this will give you certainty and clarity, and put simply, it will let you sleep at night. So that gives me an opportunity to let me introduce our presenter today, who will hopefully help you sleep. So Chris Wilson, he's our cash flow and business finance expert. He's an account manager with Benson Wood and has been with us for 7 years, and he's soon to be a director if he does well today. So no pressure on you, Chris, and now it's over to you.
Thanks for that, John. No pressure as always. Morning, everyone. As I said, my name's Chris Wilson. I'm one of the account managers at Benson Wood, and I'm going to be taking us through today's presentation. That's me. And I missed a slide. So there's first thing we're going to look at today is managing your cash. Essentially, this comes down to knowing your numbers so that you can stay on top of your business. And knowing your numbers means that you need to have a good, solid set of financials to be able to rely on. So you need good, up-to-date bookkeeping, and you need to be getting fed that information regularly in order that you can make decisions and adjust to changes in the environment. Second must-have is setting a budget for your business. That's at least annually, but you should be doing that. You should be reviewing that at least quarterly, and factoring in trends for seasonality, with your changes in your business, so that you're not getting caught short at any time. What you also need to do your budget is allow for a degree of flexibility. You might think, well, I need to be as tight as I can so that I don't get caught out anywhere. But if you're too tight, if you're too stringent, then what you can do is you can stunt your business growth if you're not prepared, if you've not factored in kind of slack to spend or invest in the business at the right time. So you don't want to so you want to be reasonably flexible so that you can take advantage of any opportunities that come the business way. The other must-have really want to do is keep an eye on your employment costs. Again, fine balancing act between what you can service your clients. You need to have enough staff in the door to service your products and services, to service your clients properly, but you don't want to have too much. You're sitting idle and you're not recovering on these staff. So again, it's the fine balance when you look at there. Second thing we're going to look at is really common sense things, but it's things to avoid and things to do. If you look at things to avoid, it's late payers, poor cash flows, essentially bad customers who don't stick to their payment terms, and who put you under pressure. I think there's been some research done, something like 1 in 5 or 1 in 7 insolvencies over the past 5-10 years have really been down to late payments, especially from likes of larger companies. if you look at the likes of Carillion and Interserve over the last 10 years, and their failures, slow paying businesses and causing smaller subcontracted businesses to fail. A lot of these guys will put you on 120 days payment terms, which just isn't viable if you don't have something like debt factoring in place, which we'll come on to later as well. Other thing you need to avoid is over trading. Basically, when you get in a boom, you think business is going well, but you're having to shell out on kind of materials and everything else, and it just basically, and you're not able to cope with what you're doing. So you need to be in control of how much you're trading. And avoid unexpected internal factors. So that can be things like losing any key staff. So you need to make sure that you're looking after your key staff, keeping them on board. Also, if you're in production, if you've got equipment that's used to make your product, you want to make sure that that's been maintained properly, so that you don't have any downtime for lost equipment. Moving on to focusing on things that you should do is accurate forecasting and financial modelling. Again, that's where you need good up-to-date financials to see how the business is doing, so that in order you can forecast and plan for the future for what's coming ahead, and be prepared for upwards and downwards movements and trends. Also, if you're going to implement anything, you want to make sure that you put that down on paper, seeing it right through from implementation to growth and maturity, and really do like a small feasibility study. Does that make sense? Is it going to work before you actually invest the cash on it? There's no point in spending good lump sums of cash on something where it's not going to be viable, or it's not going to generate the business income and sales down the line. Following on from that, you should be looking to prepare a detailed forecast, again from the up-to-date financials, looking to break down monthly your income and expenditure, factoring in any increases in prices, so that you know when to adjust your sales to reflect on that as well. One thing that can be really powerful and really a requirement, I would say, is regular management accounts to monitor and assess the impact of any changes you're making. Management accounts really helps you to keep your finger on the pulse of the business, really see how you're doing. See if you've implemented something new, is that working? What's the impact of it? You then want to kind of combine that if you've got people in-house working with you, or if you're working with an accountant like yourselves. You want to be able to combine and integrate with other accounting software programs in order that you can further develop your cash flow. What I mean by that is, if you have a cloud platform, say like sort of Xero, then you can build in kind of cash flow and forecasting tools like sort of Float, Fluidly, Fathom. These kind of things are good planning tools to help as well. What you can have with that as well, if you're doing management accounts, you can collect a whole lot of data, but where an independent advisor comes in, it's basically to help you interpret and understand that data, what it means, and help you with your plans for the future. That's where the likes of ourselves would aim to give you a helping hand, just in terms of your development of the business. If you go too quickly, you can end up falling into that over trading problem that we're talking about. If you go too slowly, the team that you've got on board might start to lose interest, enthusiasm. So, and you don't want to lose steam. Whereas if you have an advisor like ourselves, they help you manage that plan and to manage your data and accounts, we can help you to get in the right direction. And I think John's just going to share a wee bit about that as well.
Yeah, so I'll thanks, Chris. I'll jump in at that point and just to say kind of some of the strongest relationships we have with clients and the best services we provide is where we'll be involved in helping clients with their bookkeeping. So cloud systems such as Xero and keeping your information up to date and accurate. And it's a great way of being able to make relevant decisions on the business if everything's up to date. That, and part of that is, producing accurate monthly management accounts, as Chris mentioned, and up to date, either monthly, quarterly, up to date figures that lets you make decisions and give certainty and clarity, which were the two words we mentioned at the start. And also it means you can be up to date with your annual accounts and know your tax position really quickly. So it lets you plan things. We've helped a lot of clients in terms of automating their bookkeeping systems and getting accurate information. So if you do need a hand with that at any point, just give myself or Chris a shout. So I'll let Chris hand back to Chris to summarise that one and go on to the next topic.
So that's really the end of the first section. We were looking at management cash, and now we're going to go ahead and look at the next section, and actual cash flow forecasting. That kind of touched on, cash flow is so important in running a business. It's an old adage, but cash is king. If you don't have the cash in your business, essentially it won't be viable, and it won't survive. It is so crucial. And we've seen like over the past year, I think that's just highlighted just how important it is to have the cash in your business, but also to be on top of it. Going in and out of lockdowns, I mean, just having kind of trade just up and down constantly. You need to be in a position where you're planned and prepared, even for the unthinkable. I mean, a year or two ago, and certainly no one had seen this coming. And that's why you should be doing this regularly throughout the year. We should be doing 30, 60, 90-day cash flow forecasting based on the most up-to-date information you've got from your financials, and estimating how much you expect to sell, and allowing for degrees of slack either way for that. If you sell more, if you sell less, making sure that you're in a position to cope with that. Let's look at what a well-prepared forecast covers. There is essentially 6 main things that you want to be able to do and to get the benefit of forecasting. Predicting sales performance. So again, that's using your past trends as a kind of basis, but also looking ahead at the future, what's coming down the line. So things that are opening up just now. People have got money to spend. Are we factoring that in? Are we trying to target them? Estimating costs and spending expectations. You probably see if with the amount of people that have been doing works in their garden and everything else, the kind of demand for timber and supplies and materials is going through the roof. So the costs are going through the roof as well. So if you're a builder, you need to be factoring that in, so that you're not losing on your margin and then impacting negatively on your business. Indicate cash coming in and out of the business. Again, so your cash is coming in mainly from your sales, but is there any further grants you're getting in? Is there any further loans that you're entitled to that you want to apply for? Going out, you've got your suppliers, you've got your wages, and these are going to vary depending. Are you building this in, and are you prepared to be at the lowest ebb? Are you highlighting your pressure points? Is there a point you foresee your cash getting down to a critical level, and what can you do in advance to prepare for that? Can you get an overdraft in from the business? Do you need to switch to invoice financing just so that you can improve your cash position? Or do you have bad customers, or or are you not in control of your credit control? It can be so hard for owner-managed small businesses to manage the full pot of things. So when it comes to chasing customers for payment, we struggle for time. We maybe struggle with that barrier. We don't like asking for money. So we need to improve our credit control skills, or we need to look at getting systems in place to help that, or even people outsourcing that as well to take care of it for us. What you need to do as well is focus on your successful services or product lines. You'll know yourself if your business is product based, if you're introducing new products to sell, there'll be ones that just don't work out or negatively impacting, whereas you'll have your really good ones. And as early on, you need to ditch your dogs that are not making you any money and focus on your cash cows that are going to generate you profit and going to generate you cash. What we want to do is then move on to a profit and loss forecast. So what this will help you do is, going further down the line, is estimate your tax the business is liable for. So if you're self-employed, that's your self-assessment tax that's due in January and July. If you're a limited company, that's your corporation tax that's due 9 months after your year end. But what can be handy, what we recommend a lot of clients doing, is setting up a separate bank account to put these monies away. So if you're looking at your monthly management accounts or quarterly management accounts, you can estimate your corporation tax that's due, put that into a separate account, and then that's not part of your working capital. That's covering your tax down the line so that you're not getting into problems down there. What you can also do with your forecasts and your management accounts is gain an indication of loss-leading products and your negative cash flow. So these dogs that we want to ditch, we want to catch these early on and get an indication of what's not selling, what's costing us money to hold on to stock and things, and let's get rid of them. What we can also do is then understand the costs of new products. As again, it's in such a state of flux just now because of Brexit, because of the pandemic and the supply and demand, that costs are up here just now. They may come back down. So we need to make sure that we can understand these so that you can then price effectively, so that your margins don't get squashed. Say probably that we slide there, apology, but one thing I wanted to focus on was credit control, which I've touched on. So that's where we need to be targeting the customers who aren't paying you on time. You'll have your good customers who pay you within a couple of days or pay you on the spot, no problem at all, and you want to keep these relationships and focus on them. There will be clients who are terrible payers, where you may need to make a judgment call. Do you want to keep these clients long time, or can you change the relationship? So if it comes to, can you offer them incentives? If they're used to paying you within 60 days, can you offer them like a 5 or 10% discount to pay you within, say, 30 days, and then improve that control, improve that relationship? What you should also do as well, apart of your credit control, if your credit terms are, say, 30 days, once that invoice goes, say maybe a few days before that's due, it's worth a friendly phone call to the client to say, or the customer, so you just want to see you're doing okay, and just wanted to double check everything's still on track for payment for this week, or if we need to do anything to accommodate you. So that could be the case. You maybe spread the payment over 2 or 3 weeks or beyond, and a lot of clients will appreciate that because it may be coming to the payment deadline. They might just be burying their head in the sands. You're making the first move and taking control of that for yourself and for them. That can be a time-consuming job. if you're doing so many invoices week in and week out, and that's where it may be helpful to seek professional support from the likes of an accountant, like ourselves, who can assist with credit control and doing these roles for you. We know how important it is to maintain customer relationships, maintain that goodwill, but we also know how important it is for you to get paid, to get the cash into your business for you to operate. And that's where we want to offer a helping hand as well. And just want to pass over to John just to speak a bit more of that as well.
Yeah, again, just to give some examples of that in practice. So, we've produced cash flow forecasts for clients over the years, and it can be just a simple Excel template. We did a simple one for a client recently, who had a minority shareholding in a building in a new company. They had a very complex set of projections that we simplified it for them so they could see exactly where they were and where they were going with the new business. As Chris mentioned, if you've got cloud accounting software, you can link it to some apps which will produce forecasts for you, such as Float and Fluidly. And what they do, they use artificial intelligence and base their projections on what's happened in the past. So the more data that's in there, the more accurate they can be, and you can change your assumptions easily on them. So we've done that for some clients as well. In terms of credit control, suppose I would say practice what we preach. So we use in our business an app called Chaser. And what it does is maybe a few days before the invoice is due, it will send a friendly reminder to the client just saying, just to confirm everything's on course for payment. And then it will send reminders after that if the customer hasn't paid by the due date. And, the wording can be changed, and it's all just fully automated, frees up your time. So we can help you set up that kind of system. The other thing the cloud accounting systems are good for is when you send out your invoices, you can have your various payment options listed on the invoice, a traditional check, bank transfer, but you can also have a button there, and it will take the customer onto a payment screen, and they'll be able to pay by debit, credit card, by Apple Pay. You can set up a PayPal button as well, and it gives clients a direct debit as well. It gives clients and customers as many options as possible, so that you're making it as easy as possible to be paid. So that's some of the ways practically that can improve things, and we can help. So I'll hand back to Chris to wind up that section and go on to the next one.
Thanks, John. So that's us covered the cash flow section, and just because we're going to finish it onto that, we're now going to move on and have a look at pricing. Pricing is so challenging, even more so these days. Just the fact that there's every industry out there always seems to be so competitive. There's so much information online. So you're competing against online competitors, and customers out there are able to get so much information about products and services out there, and so they have their own ideas of value and how much they think products and services should cost. So what we want to look at is how to target clients and how to compete against their competitors. We're really just going to look under three sections in this small section. The first one is incentivizing, offering a sale, discount, or add-on. Well, you'll see that. I mean, most common example of that is like if you think of cars, where the registration plates change kind of like March and September. So the new car sales guys will be trying to push the kind of March pre-registered cars out the door before the end of kind of like August, September, but before the new regis come in. So what they'll do is they'll say, oh, we'll give you pre-service and we'll give you this, we'll take 10% off. So it's that kind of idea, and it should be seasonal. It should be like for a targeted space of time where you're kind of offering a discount or putting a promotion on, so that the number doesn't wear off. It's for a time period, and things like that. If there's old stock in the door, if it's fashion based, if there's things that are coming out into a new season, it's these kind of things you want to be making sure you want to make the most attractive, and you want to be able to sell it, get your cash in for it without you having to have the cost of holding that stock. Second thing to consider is price matching, in terms of competing against and even kind of like freezing out your competitors. That could be, so you might have similar products, it might be the exact same product, and initially yours may be X amount more than your competitors. So do you want to come down, do you want to match your competitors, especially if they're new into the market? Do you want to kind of squeeze them out before they're able to get a foothold? Again, that's a balancing act, because you need to set your pricing based on your costs, your staff, your labour. You need to make a decent margin on your product, on your service, to make the profit, to generate into cash. So if your price matching squeezes these margins down further, it may come to a point where it's just not viable to do that. So you either need to think, well, I'm not going to get into that battle of price matching, or I'm not going to sell that product. What you also want to be very wary of as well is if you're in a niche market where, say, a competitor comes in, but you've got confidence in your product or service, it's high value, it's high quality, you do not want to diminish that value in any way. You want to avoid price matching from that point of view. You need to be confident of what you're doing or what you're selling, and getting that across to customers. Customers don't, if they're paying a high price for your product and it's a high value, they don't want to see that diminishing in value, because that could translate into being perceived as being an inferior product or service. Other things to look at is psychological pricing. That is in terms of, I mean, it's been about for hundreds of years, in terms of, instead of just selling a big high round number of 10,000, you bring it down to the nearest 9. So instead of selling something for 10 grand, you sell it 9,999. Now that, as long as it's been about for that period of time, people still perceive that as getting value for money, as getting it's been a better option. People still do that on the kind of low cost shops, like 99p store, your B&Ms and things. So it does work. Again, you just need to be careful of that you get the right price and how you get that across to your clients. Again, as I briefly touched on there, in terms of kind of price matching, be so aware of your margins. You don't want to be getting sucked into a fight, and then you end up losing that fight, and then a couple of months down the line, your profit and your cash is taking an absolute beating. So it's being aware, it's picking your battles for your products and your services, but not compromising on your margins, which are so important for the long term. Also, what you need to look at is how your product, how your business is perceived. There's lots of products out there that are in completely different markets. If you think of a car, there's to get you from A to B, people will buy a Bentley. some people will buy a Ford Fiesta. It does the same job and it'll do the same journeys, but you're in two total different markets in terms of quality and expectation there, and what people are looking for. So sometimes it's not all about the actual price. People value the product, value what they see. So you maybe need to invest more in your marketing side. If you've does your website, does your advertising, or does it all stack up to the quality of the product that you're trying to sell? Then there's the full subjective versus objective. So that's pricing versus opinion. So people will have their own opinion on a product or a service. That's subjective. What's attractive and what's valuable to one person will be completely different to what's attractive and valuable to another one. Whereas the price is objective. It's set. The price is what the price is. Where you give people a problem is where they look at a competitor selling, or if you and a competitor are selling the same product at the exact same price, there's this situation where they call analysis paralysis. Well, if they're selling that at that price and they're selling that at that price, why should I choose either of them? So that's where you want to understand who you're competing against, and do you want to undercut them? Can your margins take that? Do you want to charge more for that? And again, look at being more niche, more quality driven. So it's about understanding your place in the market and your products and your services. And you may have a range of products. So there may be some high end, high value, high niche, high quality products where you want to focus and not compromise. And there may be at the bottom end of the scale products and services that are open and wide to so many different competitors that it is low value, low quality. So you need to assess where you are and where your products are on that scale and price effectively according to that. And we can help you do that as well, which I'll come on to just now. It's so hard to get pricing right. I don't think you'll ever get pricing 100% right 100% of the time. It's a constant thing you need to be reviewing in terms of your products and services, because costs change, things change, trends change. And this is where it's part of the whole process, looking at your cash flow, looking at your profit, looking at your accounts, and look at the market you're operating in. We can help you out here, which John will expand a wee bit more on just now.
Yeah, so just to touch on that, we talked earlier about forecasting and projections, cash flow forecasts. So if you decide to change your pricing or discount for a short period, or change your product mix, concentrate on certain products, that can be amended on the projections, and it can show the impact on your cash flow and your profitability. So we can help you with that if you are looking to maybe introduce some of these pricing strategies. So that's a good way of trying it out on paper first before you actually go ahead and start doing that. So that's where we can help you. So hand back to Chris to go into the last section.
Yeah, John. So we've covered the pricing, and our fourth and final topic is to look at business financing and the options open to you out there. Now, in a perfect world, we would do the work, we would send out the invoice, and we would get paid in time every time, and that would give us the cash into the business that we need and help everything to run smoothly. But as we all know, it doesn't work like that. As we've covered, there's bad customers, there's sometimes good customers that bad things happen to, that impacts on us. So what we need to do is look at the cost of doing business and the funds we need to meet these costs. And that's where business finance really comes in, because at different times in our business life and business journeys, we will need finance to cover certain things for different reasons. And that's what we're going to just go through here, is to try and kind of reduce that gap that where we don't cut out, where there's a gap between getting paid, getting money into the business, and funding the business operations. We want to use finance to close that gap, with it being reasonable and viable, and making sure we've got a smooth operation of the business. So let's look at some of these options. I just get a problem with the slides again here. First one is working capital funding. What that can cover is essentially the working capital we need in the business. So that's getting money in from our debts, selling our stock, getting money in from our debtors in order to pay our short-term creditors. And things that we can look at for that is credit cards, overdrafts, even debtor financing. That's the factoring, and stock finance. And I would say that these options, particularly likes of debtor invoice financing, used to be so strict in the past. If you got a factor or finance company to take that on, they would request 100% of your debtor book, and it all had to go through them. Nowadays, that industry is more competitive. There's more people to provide that service for you, and it's more flexible as well. So then you may be able to have so much of your good customers that you don't need to put down that route. But there's certain ones, there's kind of like certain kind of projects that you could put on that as well. Finance for longer term assets. So that's really looking at where you're investing in the business and equipment, machinery you possibly require. There's different options there. There's your traditional hire purchase options, where it's like a 4 or 5 year term, and at the end of the period, the asset's yours, and it'll still have value to generate income in the business. You can also look at finance leases, where you have primary and secondary periods, and they can sometimes tie in kind of options to buy in this time as well. And again, similar to the HP, you're paying out a monthly sum rather than a big lump sum of cash up front in order to kind of protect your cash flow. What you can also consider in terms of equipment is contract hire, almost like operating leases, which can protect you in the sense of depreciation. So if you're taking out a lease over 3 years, that asset's going to depreciate over that time. It may go rapidly, or it may be slower. So if you take that over the likes of a contract hire, you can protect yourself from depreciation that way. Certainly worth considering just now if you look at the likes of cars and things. Then there's startup funding. If you're just a new business and you're looking to get funding to get set up and get going, there's various options that you consider. Cheapest and most selectable, I'd say, is family loans. If you have that availability within the family to do that, and there's grants that we can help you apply for, and there's still banks to go to help with startup funding. What you will need to be able to demonstrate that you're worth that is a decent business plan and forecasts, which again you may need some input from the likes of ourselves with. If you're trading internationally, particularly just now with Brexit and things, the costs involved here can be higher. There are things like import and export finance options that you can get through banks and through lenders, which will help you close that gap just again with the time delays and getting your product out to the customers and getting paid, and the same getting your materials in. Alternative finance options will cover things like crowdfunding, which you would, I think 10 years ago, you would never have kind of dreamed of going down that route, but it's becoming more and more popular and could be a potential option for you to consider. What I think most businesses have done, certainly over the past year during the pandemic, is take out bounce back loans, or even the CBILS loans. Where next section just going to move on to is just look at how the options about repaying that and about possible further borrowing, the likes of the business recovery scheme. Bounce back loan. So these were capped at kind of 50k, roughly, or 25% your turnover, if that was less. What the banks and the government have agreed to do is use these pay-as-you-grow options. So there'll be times where you can pause the repayments for, say, kind of like 3 to 6 months, or make interest-only payments for 6 months. Or possibly extend the length of the loans. There's certainly been negotiations to do that. We've already demonstrated that in the sense that you can go from a kind of 6-year period up to a 10-year period to reduce your monthly repayments, and when you want to start repaying. And the interest on these was fixed at 2.5%. You may have opted for the slightly for the bigger loan, which is available for going up to 250k without a personal guarantee, and beyond that on similar terms as the bounce back loan. These have been guaranteed by the government up to 80%, and anything above 250 has had to have some kind of personal guarantee attached to that. Again, there is scope for extending your repayment terms with your bank, which is worth looking into. And it may be the case, some businesses have been able to do reasonably well through the pandemic and may have a bit of cash put by. So you may want to just get rid of this loan, or certainly a good part of it, so that it's not hanging over you. Yeah. A lot of times, these kind of loans will have early repayment charges if you pay more than the percentage of the balance. This doesn't apply to the CBILS, so there's no issues that way if you want to repay early. But so the business is liable for the repayments, certainly if you're over 250k, and even at 20% that the government's not been taking responsibility for, the business will be responsible for the 20% of that loan. As we talk about cash flow, it's so important that you factor this in. Certainly, if you've done it on the initial 5-6 year period, you maybe want to think now, well, to give us more scope to grow, scope to invest, it's worth putting that into a 10-year period just now as well. The CBILS loan scheme finished at the end of March, and the business brought in the recovery loan scheme, which has been operating. This basically allows the business to borrow from 25k up to 10 million over a 6-year period. Unlike the bounce back and the CBILS, there's no interest-free period. And what you will need to apply for this and to get the funding is financial trading results for periods between 1 and 3 years. That's where it really hampered a lot of new start businesses last year, where they maybe didn't have kind of sufficient trading to meet the criteria for bounce back and for civils. So it's possible now that you've maybe got a decent trading period under your belt, and you may want to take advantage of the business recovery scheme while it's in existence. So it's going to be open until December 21 this year. Certainly is worthwhile looking into if you're going to need some loan funding to help your business operate over the next 6 months before that window closes. They've not said exactly if the interest rate's going to be the same at 2.5% as the previous ones, or if it may be a wee bit higher. But it will be, I would expect that it will be less than your traditional bank loans, right, from your traditional banks. On that note, what I essentially want to do before we finish up is just again say that we can offer a helping hand with this, because many of these banks will want to see up-to-date financials, want to see recent accounts, and possibly even some narrative to help you with these applications. So on that note, I just want to pass you over to John, who can explain a bit more about what we've done to help there as well.
Yeah, we've helped clients apply for various loans and help them with obviously the form filling part of it, but provide backup figures to enable successful receipt of the loans. One of the things to bear in mind with any sort of business funding are the tax implications, and we've not touched on that, but that's important. So if you've got any kind of plans for investing in assets and taking out finance, speak to us and we can advise you in the most tax efficient ways of doing these, going about that as well. So yeah, various ways that we can help our clients and customers with regard to obtaining business finance and explaining to them about the tax position. So back over to Chris to wind things up. And then we'll have a look at and see if there's any questions being asked as well.
Yeah, absolutely. I've got one final thought. I'll leave us with before we finish. But have we got any questions in the chat box, John, to run through just now?
I've got one from Laura on the best way of financing an electric car purchase for a company. So again, we'll give a brief answer on that. There's different ways of doing it. There's contract hire, which protects you from depreciation. There's HP, which will mean you get more tax relief up front. But there's kind of a few different other options in between. So if you maybe drop us an email and we can get into further detail on that. And the other question was from Bob on trade debtor financing. So the trade debtor financing is where you, when you invoice your money, when you invoice your customers, a trade debtor finance provider will pay the say normally about 80% of the money up front. So that it's got a positive impact on your cash flow on the short term. And the question is, do all my customers need to be handed over to the trade debtor finance provider? And the answer to that is traditionally that was the case, but there's more flexible options available now. So again, come to us and we can discuss that with you. So I'll hand over to Chris just to wind things up, and after that I'll advise you on our next webinar that's coming up later on this month. So over to you, Chris.
Yeah, this is my old Jerry Springer moment, my final thought for the day. Really just what I quoted earlier on, the old adage that cash is king for your business. It's so important and it's so crucial. So you need to make sure that is your priority. in terms of doing that, you need to make sure the business is profitable. You need cash in the business to invest in the business, to make it better, to achieve what you want to do it, for it to achieve what you want it to achieve, and to get out of what you want as well. So you need to invest in the business, and you need to invest in yourself personally as well, to make these things work. And at the heart of that is your cash. So it's making your business as profitable and as successful as you can to build up that cash to achieve this. On that note, I would just like to thank everyone for attending and joining in today. I hope you can get out and enjoy the sun while it's about just now as well. We'd be more than happy to have a chat with you on anything that's been raised, anything additional as well. If you drop us an email, my email's at the end, it's chris.wilson@benson-wood.co.uk. You'll also get us on the office number. It's 01236 756 161. We're also on Facebook and LinkedIn. If you search for Benson Wood & Co, be more than happy to have a chat with you, chat through anything further.
And finally, just on our next webinar, which will be on Thursday, the 17th of June at 10:30 a.m. And it's the next in our Business Challenges series of webinars, and it's the new age of work. So how we work is changing. As are the expectations of many employees. To reflect these alterations to the world of work, many businesses are adapting their employment policies and approaches to making them more flexible. So we'll be having a webinar on the shift in working practices presented by Caroline Cabane, who's an Associate Director at Just Employment Law. So we'll be talking about office versus home working and managing staff remotely, well-being issues, remote recruitment and training, and vaccination policies. So if you would like to attend that, we'll be sending out invites to that shortly. So thanks very much for attending today. We appreciate it, and we hope to see you soon. Thank you.
Thank you.